I just want to quickly introduce Dr. Peter Linneman. I've had the privilege, and maybe some of the other people in the room have, of hearing Peter speak at a number of engagements in the multifamily and capital market sector for years. I was really honored that he would come and speak with us today, and so thank you very much, Peter. Very appreciative. Always been a big admirer of his kind of opinions and how he sees the world. Great communicator. Most importantly, he is from currently in Philadelphia, Pennsylvania, has been since the 70s. So anyone that has known me for longer than 30 minutes knows how much I love Pennsylvania and specifically Philadelphia. So it's great to have a Philadelphia native here with us. A little bit about Peter's bio. Currently, he's on the staff of Penn. He's been there for a number of years, and does kind of a lot of economic summits and things of that nature on top of his professor business. But over 45 years, has provided a blend of scholar rigor, practical business insight, and has won him accolades around the world for that. And so, like I said, he's currently at Wharton right now, and I've had the privilege of hearing him speak in some of his seminars up there, and just really enthusiastic that he's here today with us. So Ken Carpenter, our president and CIO, is here as well. Ken's going to kind of lead a little bit of a fireside chat and put Peter on the spot, and Peter can tell us how he's going to solve all the world's economic problems. And coming out of COVID, unprecedented shutdown, unprecedented, spending, followed by unprecedented interest rate hikes. So I don't think, to touch on that, I don't think really, when you really step back to where we are in 2026, Peter, for me, everyone talks about interest rates, but you kind of got to go back to when you think about what is, we don't talk about COVID anymore like we used to, but how hard it has been since COVID. In March of 2020, we shut down our company and didn't know when not shut down, but, we're going to work from home. We're going to figure out, how do we keep a business going? How do we, how do we do accounting? How do we do all these things? How do you hire people? And to go from that, and then you had this really kind of euphoric window that lasted for a brief period of time. Values went through the roof. People are feeling great about things. There's money. And then, out of nowhere in the fall of 2022, at least in our world, we kind of joke we've been in a recession since the fall of 2022, our industry. You don't hear that word a lot, but that's kind of how at least us in the private real estate sector and the public real estate sector have thought, and values would probably kind of support that theory. So you really can't, I don't think, appreciate how hard it's been to run a business, manage around the capital markets, and what's the geopolitical things. Obviously very unique times in terms of two very different presidents in office. So it's been a whirlwind, to say the least. So thank you for being here, Peter, and thanks, Ken, for driving the boat here.
Thank you for having me.
Thank you. Yeah, I've been able to see Peter before and watch him and meet him, and this is a true honor for me. So I appreciate it and thank you. And I'm going to try to at some point.
You need a better life if this is an honor.
And we'll try to leave time, which I don't even know how much time we have, but we'll try to leave time for questions at the end, but for the audience. But I think we'll start with yesterday. Chairman Powell decided to leave the benchmark rate in the range of 3.5 to 3.75, and I guess it was a 10-2 vote, right? And 2 dissenters, and I guess one would be expected in Moran. And I guess the question is, what do you make of their pausing after 3 decreases, and then maybe a little bit on was this an audition for Waller to try to become the chairman at some point? So what's your take on holding steady yesterday?
Okay, so I got right the last 2 years. The interest rates, what they would do. They backloaded them each of the last 2 years. I think they're going to backload this year as well. When they say the rate is 3.5 to 3.75, the effective rate's about 3.6, 3.65 right now, transactionally. They didn't do anything unexpected. I don't think anybody in this room was shocked that they kept the interest rate the same, right? You may have wanted them to do something different. We weren't shocked. Why? They don't want to create a sense of panic. They don't want to create a sense, they're human beings. They don't want to create a sense that Trump's in charge, right? And by the way, they want to send a very clear message. We're in charge. Have any of you ever sent a message? We're in charge, right? That's all they're doing. And they're going to do it again next month, same way. Probably into March, same way. I'll come back to what's then going to happen. But the dissent, the 2 votes, people react as if dissent's a bad thing. How many of you think that dissent in opinions is a bad thing in general, especially on things that are hard? I view it as a good thing. In fact, one of my big complaints about the Fed during the Powell years is the lack of dissent. I don't care which way the dissent goes, higher or lower rates. When the rates were very low, there was no dissent. When the rates were very high, there was no dissent. So I view the onset of dissent, this is hard, right? There should be dissent.
Right. I think people forget it's a 12-person body making decision. It's not just the chairman.
In a funny way, the chair has influence, just like the chair has influence of anything. But it's like this Supreme Court Chief Justice, right? They have a disproportionate influence.
So there was even some talk yesterday, could there be even a potential increase? And I think the answer was, despite solid growth and despite some tariff-related increases, that wasn't in anyone's sort of future. But I think you disagree with the potential for going up. And what's your prediction, perhaps, for the rest of the 26?
Go back to what I was saying. About let's just call it 3.6 is the effective. Let's forget the band type of stuff and just call it 3.6 to make the math simple. Inflation for the last 2 years, on average, for all items that people purchase that are tracked in the Consumer Price Index, has been 2.1%. Over the last 2 years, 2.1% per annum. Over the last 2 years, for the 80,000 items that they track, they being the Bureau of Labor Statistics track, that people actually purchase, okay? 2.1%. That same number for the 30 years prior to COVID, the shutdown in March, was 2.2% annual average. What's that tell you? For 2 years, inflation has been normalized for the 80,000 items that they track that people purchase. Are some higher? Yeah, some lower, of course, right? We have been for 2 years for the items people purchase that they track at 2.1%. If you're at 2.1%, why do you have a 3.6% rate of return given to somebody for doing something very short term that's not very risky? That's a pretty good spread from a risk, just a risk point of view, right? I mean, maybe lending to you, 150 would be a fair short-term rate, but we're not talking about that, right? We're talking about very short-term safe, okay? Now, my view is it should be 50 to 75 basis points over inflation. And I could have a long discussion as why, but that's my view. You would find some people who would say, no, it should be like 20 to 50 basis points over. And you would find others who say, no, it should be 100 to 150, okay? And they have reasons why they believe that. So you say, 50 to 75. So let's take the 75 basis point. Take my upper range over. And let's say it's 2.2, not 2.1. I told you it was 2.1 for the last 2 years and 30 years prior to COVID, which changed. We're back to that. Okay, so 2.2 plus 75 basis points, just under 3. And we're at 3.6. Okay, what's that tell you? Cut at least 50 and maybe 75. Right? This is not rocket science. Now, the only thing that gets interesting is, but you believe the norm should be 25 basis points. So then there's more.
So I was going to say, as it relates, as you think about the next potential chairperson, is it and you say they don't want to be like they're in Trump's pocket or being influenced. What is your thinking about how and who that next person will be? Not that they're going to be influenced necessarily, but maybe they're one of the believers that it should only be 25%. How do you think about who the next chairman will be?
I think it's very similar to the Supreme Court. I'm not a legal expert, but they're not auditioning a justice of, are you going to do what I want you to do on any particular case? What are they auditioning? They're auditioning it, are your generic underlying beliefs in line with my generic underlying beliefs, right? Because it's going to be a long-term appointment. Fair enough? That's going to outdo me. So if you were president, and it's clear that President Trump has a view of, he's a former real estate guy, probably minus 50 basis points. But,
Do you think he likes leverage?
But let's say the Trump view would be, okay, it should be 0 to 50. And you walk into an interview and you went to the same school as everybody else, you worked on the same banks, you worked at the same this, same that, and you say, I fundamentally believe it should be 175 to 200 over. Am I going to pick you? No. You're going to pick somebody they all have resumes. They all went to the same bullshit schools. They all work for the same bullshit banks. They're all just people with their own. They're going to pick, he's going to pick people who align with his view. And it's not like he's going to be called, what? He's going to put a hit out on him? Or what, that's silly. It's the people they pick. So what's that mean?
So is that like selection bias to some degree?
It is a kind of selection bias. And of course, since they're picked by different presidents over time, you get kind of a staggering around. And so what's that? What do I think that means for this year? You're going to get a couple of more appointments of people who believe lower than I believe. Okay? And you can start seeing how that works, because nobody had a hard time getting, I don't think you did, getting from 3.6 to say 3, right? So that's 50. And they'll backload it because we don't want to do it now because we want to show we're independent. Did any of you ever show that you're independent in life, like to your parents, like, screw you, I'm not coming home at midnight, I'm coming home at 10 after. That's what's going on. They're coming home at 10 after. But by the end of the year, you'll have a couple of more votes. And you could get surprised in that it won't be 50 that they'll cut this year, but 100. And you'll say, were they strong-armed into it? No. They picked a couple of people who believe 25 or 50 is ample return.
Above inflation.
Above inflation is an ample return, which would be kind of 2.5, which is 100 versus 3.6.
So let me ask you this. We're real estate investors in this room. Every time you talk to somebody, whether they're on the debt side or the equity side, everybody wants to know where the 10-year treasury is. And most real estate is financed, right? It's a leveraged asset, and anywhere from 50 to 70%. So there is a theme and a thinking that as the 10-year goes, I mean, we can certainly see charts where cap rates diverge and converge with 10 years if you look over enough time. But if real estate prices over the 10-year to some degree, why should we even care about where the short-term rate is?
That's a great question, because the Fed does not control the long-term rate, okay? They control the short-term rate rather than the market. The market controls the longer-term rates, right? But now imagine the following, and I'm just making up an example. Suppose this is like a physics, remember your physics class where they turned the heat up a lot on an experiment or increased the pressure so you could see what would happen with greater clarity. That's all I'm going to do right now, okay? Imagine that yesterday the Fed had announced the short-term interest rate is 1,000%. Okay? What would happen to the long rate? It would, everybody would leave long bonds immediately and real estate to go into short. Because if I can get 1,000 and inflation's 2.1%, only an idiot would take risk the other way, right? So what would happen to the 10-year? It would knock on. Fair enough? And by the way, if they said the short rate is 0, it would knock on because it has to compete, right? So it does affect the long rate, but only as money flows to arbitrage. That makes sense, the spirit of it? So if they change 25 basis points, do you expect a 25 basis point mechanical move in the long rate? No, but you'll see a ripple, right? You don't see it mechanical lockstep. And remember, there's a lot of other stuff going on too, so that ripple can even get lost in the shuffle. Make sense?
Mm-hmm.
Now, the other thing is, you were suggesting that the long rate determines let's say the 10-year, just to be mechanical, determines real estate pricing, determines cap rates. Well, I believed that until like 2013. And then I came out of the financial crisis going, now hold on. We just had interest rates at 0 on the short end. And they still were at 0 at that point on the short end. And at the long end, they were really low by historic. Remember when the Wall Street Journal was talking about bonds being floated all over the world at negative interest rates? Okay? That was that era. And I'm going, well, but I don't see really low cap rates.
I was going to say, cap rates certainly didn't come down in that period of time.
Were still really high. In 2009 and 10 and 11, they were anything but low. And I kept going, how's that work? So then I went to the data. The data is not perfect, but it's pretty good. And you look at cap rates and how they move compared to 10-year Treasury. And the answer is, no notable relationship. Now, that doesn't mean one is up when the other. When no notable relationship says what you were saying, they kind of bounce around. I go, well, how is that? And the answer is two-part. Let's take the first one. If the 10-year rate changed by 6 basis points during the course of a deal, are you going to reprice your deal by 6 basis points? Well, not even 6 basis points because you're only borrowing 60%. So 3.6 basis points? No. So if they're small movements, no relationship. Everybody get it? So that's a lot of data that you find no relationship. Now let's do the big ones, and let's go back to the financial crisis. What happened? The interest rate went to nothing, but cap rates went up. You're like, that's crazy. Why'd they go up? You say, but the weighted cost of capital should be lower because debt's cheaper. Debt's cheaper if you're the U.S. government. Are you the U.S. government? I don't think so. What happened to real estate? Nobody'd lend to you.
So it didn't matter what the rate was.
It didn't matter if nobody will lend to you. So think about the weighted cost of capital, right? You went from, let's say, 60% debt, 40% equity in a normalized risk market. Now the interest rate goes down because everybody's terrified and going to safety. And now they'll offer you 30% debt, okay, at a lower interest rate, but a bigger spread over the interest rate because everyone's terrified. And you got to go replace all that debt with equity at a time when equity is really expensive because everybody's terrified. And the weighted cost of capital actually goes up in those extreme moments. And the reverse happens when everybody's got to get in. So what did I find really matters for cap rates? The flow of money. And again, let's do the physics.
Well, let's think about after COVID. Rates did go down, and cap rates definitely followed down. And your supposition or your research has proven that that's actually a flow of funds.
It's a flow of funds. When money flows, values grow, cap rates grow. And you can look historically. You can go back and find the episodes where money didn't flow. And I don't care why the money didn't flow. Could have been the Middle East problems in 1974. Money didn't flow. Cap rates shoot up. Could have been an economic money. You find all of them. Each of them had a different cause. And when money really flows, it doesn't matter what the interest rate. So here's my physics example. If I told you, we're in Charlotte. So if I told you, I just said that in case you were forgetful about where you're at. This is just a reminder. No, suppose I told you by the end of business tomorrow, $40 billion has to be additionally invested in Charlotte apartments, or the head of every private equity firm in the country, and the head of every bank in the country, and the head of every non-bank bank will be executed at midnight tomorrow night. Do you think the money will flow? I do. Right? Anybody doubt that? What do you think will happen to cap rates if suddenly $40 billion tries to get into Charlotte apartments? They'll plummet. You didn't ask what was happening to interest rates between today and tomorrow. And by the way, if you did the reverse, what if they had to get the money out or there'd be executions? Now, I'm just making the thought experiment to drive the point home. And that's what I find in the data. Lots of movements where nothing happens that are relatively small, and a few movements that are happening either when I got to get out, got to get in. Cap rates go down if I got to get in. Cap rates go up if I got to get out. And so the 10-year has a pretty minimal impact. It has implications for how you finance. That's different. That's a different phenomena, right? How you finance.
So just thinking about like this morning, the stock market seems to be at an all-time high. Gold at 55 something an ounce. Hear about the dollar now. It was parity 1-to-1 with the euro, and now it's 120. What's your take on? Is that a sign of people having trouble with our $40 trillion in debt and our $2 trillion deficit? I know you have some good views on why we maybe shouldn't be concerned about the absolute number, and maybe we should be concerned about the trend, but maybe not the. Talk about your views on our current $2 trillion deficit and the wealth effect.
Okay, so I'm an old Milton Friedman student. I don't know if anybody knows who Milton Friedman was, but pretty much a fiscal conservative. And I am a fiscal conservative. So bear that in mind in everything I say, okay? For this country, at this point in history, it really doesn't matter what our deficit is from a can we finance it, can we survive it. So I'll be 75 years old in, like 7 weeks, okay? And in my lifetime, people have said, we can't keep running these deficits because if we do, the economy will come crashing down. And you know what's happened over those 75 years? We just keep running deficits and the economy doesn't come crashing down. That makes you ask a question, what's going on? So I went back, and when I'm born in 1951, I'm doing these off the top of my head, so I may be off slightly, but I'm pretty close. Household wealth, net of debt the household owned, was $750 billion. And largely as a residual of World War II, we had $250 billion in outstanding federal debt, which, by the way, was a liability of American citizens, right? Those households. So let's net that off their wealth. Fair enough? So 750 minus 250 was $500 billion. That was 1951. Okay, come back last year. And we have this is actually higher, but I'll stay with the number, $175 trillion net household wealth. That doesn't count our forests that the government owns, and it doesn't account and so forth, all right? But let's just ignore that. $175 trillion of net worth. We have $25 trillion, I'm rounding, of outstanding federal debt that's not owned by the government. because the government owns a lot of its own debt. And you got to net that out because, yes, we pay interest on it.
We
but
pay
who
it to
gets
ourselves, right?
The government gets it, right? So they pay it and they get it. And it's an asset and a liability. So the real liability is 25, right? So 175 trillion minus 25 trillion is 150 trillion. Got it? That's the net wealth. Okay? That's the net wealth. Now, think of the following. We could pay off that federal debt. Not should we. We could pay off that federal debt, and we'd still have $150 trillion. We'd be pretty wealthy. We have more than enough wealth to cover it. Let me give you another math. Suppose our wealth, which over my lifetime has grown at an average annual rate of about 9% a year. Okay? About 9% a year. Annual wealth has grown in this country. That's not a recent phenomenon. That's over a long period of time. Suppose it grows at 1/3 that rate. So we're going to have, greatly reduced. Now, everybody's talking about AI making it much higher growth rate, right? But suppose it only grows 1/3 the rate. It grows at 3%. 175 trillion wealth growing at 5%. Excuse me, at 3%. It's like $5 trillion, $5.5 trillion. Let's call it $5 trillion. Fair enough? So a year from now, if we only had our wealth grow by $3 trillion, we'd have $5 trillion. Our current federal deficit is $2 trillion. So it'd be $5 trillion up, $2 trillion down, net growth of $3 trillion. Did you rob from your grandchildren? Nope. You just left them a bit smaller inheritance than you would have otherwise given them. Well, that's true every day you're alive, right? That's true every day you're alive. And after all, the little snots don't deserve it anyway. They can go create their own wealth, So, everybody get the math that I'm talking about here? Nobody points this out. This is just simple math. It's like saying, can you have a bigger mortgage on your house today? Suppose you live in a Levittown home. Can you have a bigger mortgage on your Levittown home than when my parents bought it in 1951? Well, of course you can. It's worth a lot more. Why is it worth more? People are wealthier. They can afford to pay more. Well, of course you have more. Now, that's not to say we should have more debt. It's simply to say, of course, it can continue, right? By the way, it can't continue for Zimbabwe. Why? Because they don't create wealth. It was not sustainable until about 120 years ago or 100 years ago because wealth didn't grow. And in a world where wealth doesn't grow, you can't do this. So Neil Ferguson points out great societies get in trouble when their wealth, he's a historian. And he goes back and finds this society 300 years ago and 1,000 years ago. And well, of course, they weren't creating wealth. All right? Now, it's very different to say we can than we should. And to me, and this is a Milton Friedman statement, it's not whether it's a deficit or a surplus, it's are you getting your money's worth? That's the question. And if you're getting your money's worth for what the government's spending on, great. And if you're not, it's a waste. And it's a waste whether it's a surplus or deficit. And it's great whether it's a surplus or deficit. That's what people should focus on. But by getting you to focus on the deficit, it's like a magician taking your attention away from what's really important, which is, are they spending effectively? Now, you can each have your own view of that, and it would differ on everything they spend. Could be true for one thing and not true for another. But this is just simple math, if you will.
So how do you think about, when you think about, rates, flow of funds, maybe in the wealth effect, we are a multifamily owner, operator, developer, self-storage, commercial, industrial, retail properties. When you put it all together, what's your sort of, and I have I'm going to ask you, this is our first annual Investor Day. You'll be invited to the second annual. and we're going to ask you to make some predictions, and then we're going to bring them out, next year and see. But in particular, just and then I'd like to open up for questions, but. Just as a general matter, where do you see cap rates? Where do you see, and I know it's whether it's office, which we don't do really, whether it's multi, but just as a general matter, your outlook for real estate for 26 and 27.
Okay, so when I come back a year from now, anything I got right, I got right. Anything I got wrong, it was because it was Ted Danson here that said it. I'm constantly told over the last number of years that we look alike, especially since this, what's it called, Man on the Inside show. Now you're all going to look at me and go, oh, yeah. Oh, yeah. You never thought of it before. Anyway, cap rates. The easiest category to do cap rates with are apartments because they're mark-to-market income, right? You don't have to worry about leases expiring and so forth and so on. Money's going to flow. Money is, by the way, you started seeing money coming off the sidelines second half of last year. Took a year longer than I thought. Why did it take a year longer? Because the Fed back-ended their cuts. They back-ended them to the
So do you think the flows will wait till later in the year?
So the flows are going to go because you got to put your money somewhere. And as that big return for doing nothing goes down, you'll do something. And real estate will benefit from some of that something, right? So I think cap rates will come down. It's going to come down less in markets that are massively oversupplied. Why? Because they're going to get absorbed, but the risk of the massively oversupplied markets is higher of when it gets absorbed than the risk of a market that is modestly oversupplied, right?
I mean, it was Sam Zell who said supply's the issue, right?
Supply's the issue. Right. And, Sam was a very dear friend. I learned a lot from Sam. I hope I taught him a couple of things, but was a very dear friend. And I think he's right. All real estate, probably the most commonly asked question I get over the years, besides how can you be so damn good looking and so handsome and so brilliant? I get tired of that question, so I asked you not to
That's why I didn't.
I asked you not to ask that one. No, the most common one is, what market do you like? And depends whether I'm a developer or an owner. You show me a market I like as a developer, I don't like it as an owner, right? I like it as a developer for the fees. I don't like it as an owner because of the supply. I'm being overly simple. It's supply that's the issue. Demand is reasonably easy to get your arms around. It's supply. And what's nice is when you get periods like we're in, where supplies, everybody's just turning the valve to almost nothing. Now, stuff is still getting built, but very selectively, very strong sponsors. You don't get a lot. So stuff gets absorbed. Right now, multifamily, I think people are going to be shocked at how strong multifamily will be in general in 18 months. Why? You're turning down the dials on supply. And I think the economic growth is going to occur. You will get jobs. Jobs have slowed, but you will get jobs. You'll get absorption. And right now, you've got a whole bunch of markets with between 2 and 4 months of concessions, right? Not every market, 2 to 4 months of concessions. Why? Because if the market is sloppy, I got to give concessions to get you to my building. And the difference between a market with, say, 93.5% occupancy and a market with 95% occupancy is I don't need to do concessions. It's huge. I don't need to do concessions. And I think what you're really going to see happen sort of 6 to 18 months from now is concessions are going to just sort of evaporate. And this is what's happened in the past. It'll evaporate later in downtown Austin, and it'll evaporate later, and it'll evaporate sooner in some of the suburban markets. It's already sort of happening in some. So I think you're going to see cap rates come down, but even more important to values, you're going to see concessions go up.
NOI go up.
NOI go up pretty dramatically on apartments. So I think apartments are going to get a double. right? That way. And on industrial space, demand's still pretty good, and supply is slowed, so cap rates there are going to improve. NOIs there are going to improve. Flow of funds going to improve. And I think it's actually a pretty good window unless something unforeseen, really unforeseen occurs.
So let me ask you that question. I think you write in your letter, and I remember this, unfortunately, we talked about this back in the great financial crisis a lot, or before anyone gave it a name, but like, what's the canary in the coal mine? So what is I know you have 48 of them or something, and some are red and some are green, but just generally, without going through all of them, what would be your one or two canary in the coal as it relates to real estate?
So if you've ever read Linneman letter, it has all these charts and graphs and hard data and hard data and hard data. And what I tried to do with the canaries was I looked back in history and said, what did we miss? You know, the hard data, what did the soft data, if you will? And I decided as I looked at it, was two things. But one is trees grow to the sky, which obviously they don't. They top out, even really big trees top out at some point. And the other is more money than brains. And that may make it sound like I think you're stupid. No, that's not what I mean. More money than brains says I can invest $100 million wisely with the infrastructure I have in a year, and now you give me $100 billion to invest. I can't do it, right? No matter how I have more money than, quote, brains, right? And so you look for examples of more money than brains, and that's what my canaries are. For example, record-setting buyout deals. Okay, why? Got a lot of money. By its definition, record means got a lot of money, and a lot of money is hard to come by, right? So record-setting deals, that's a canary. Okay, I have 5 canaries. One of those have died, and then the other is choking because you're seeing some really big deals. It doesn't mean those deals are dumb. It just means a lot of money looking for a home. All right, trees grow to the sky. All right, AI. Doesn't mean AI isn't a real tree, but it's not going to grow to the sky. I don't know how high it is going to grow. That's a very important question. This is not to say it doesn't grow, but when there's a belief, so I look for those kinds of things, and there's a number of them. Empty space being worth more than full space. We don't have that so much now. But we've had times in your career. I remember when it was like 2007, I was on an office company, and we didn't want to lease space because we were thinking about selling the building. And even though we were a good operator and it was a great lease, the fantasy was greater than the reality, and you drove the price down if you signed a good lease, right? That's kind of more money than brains. Not that it was a bad building, but more money than brains is you think that somebody who's really good gets a good lease, and you could have done better with no basis to believe you could have done better. So those are the kinds of things I look for.
So I almost hear, and as an investor, where maybe you might have an exit to somebody that has more money than brains. If money is going to start flowing again, and we're creating real estate product, like whether it's a development, you might find somebody needs to finally put out that money. They can't sit on it forever. Money starts to flow. As an owner, operator, and developer of real estate, there may be exits to people who have money they need to put out, and money start flowing at better valuations.
So I'll give you remember I was saying how flow of money kind of determines pricing, right? Not prices, but pricing, multiples, cap rates, whatever you want to call them. Crude, I have a couple of measures of this, but a very simple measure as money is flowing is, how did the transaction volume that's occurring compare to historic norms? And the historic norms tend to trend up over time because the economy gets bigger. But let's ignore the trending over time part, right? But if transaction volumes are notably above normal, it means there's more money flowing than normal, right? That makes sense to people? And if transaction volumes are below normal, especially if they're substantially below, it means we have below normal flows, and therefore capital rates are below. Now, if you go back, 2 years ago, I'm doing this, remember, 2.5 years ago, multifamily, which is the most liquid class, was like 40% of normal transaction volume. Gee, what a shock that cap rates were up, right? What a shock. No money's flowing, cap rates are up. That number, as we speak today, I think is around 85% of normal. So we're still below normal, but we're not nearly as below normal. What have you seen happen to cap rates a little bit over the time? There will be a time where greed defeats fear, optimism defeats pessimism, money comes off the sideline, needs a place to go, and you will have transaction volumes above normal, right? You know it.
And you see that in 26, 27?
Late this year, moving in, it'll be early in that. You'll move to 103% of normal. You'll move to 107% of normal. Office, by the way, I think, it's funny, I think I'm right in what I'm about to say. If you go back 3 years ago, office transactions volume was like 20% of normal. Okay? And the good news is it's up like 40% from that point. Okay, now pause on that. What's 40% of 20%? No, oh shit, it's still only 28%. That's a technical word for this. It's still only 28% of normal. Okay, better. And you are seeing a market happening, right? But it's still got a long way to go to get to anything like normal. And there's nothing magic about normal. I'm just saying it's a crude measure of how money is flowing. That's all I'm saying.
Do you mind? Would it be okay if we see if there's some questions in the audience?
Sure. And I have had this thing I do for years, which is I pretend you ask a great question and I pretend I answer it, and then you pretend that I did, and we go to the next question. All right? Is that a fair model?
That works. So I don't know. Does anybody have any? Go ahead.
So how much below 85% have we gotten in multifamily, below normal transaction volume?
How far were we below? So the question, I'm just,
you can
repeat it. I don't
go ahead.
One of us should. The question was, how low did we get below normal transaction volume? And I'm doing this from memory, but like 2009 and 10 was down in the 15 to 20% of normal transaction volumes. And of course, cap rates were ridiculous, high. And I think we got down to about 40 to 45% of normal in 2022,
23, right?
Yeah, I just said, and it's still below normal, but it's not nearly as below normal, and so that gives you a sense. We're within sight of normal, but do you want to live normal? You want to live better than normal, right? So,
in the back there.
Yeah, Peter, so I'm going to ask you a question. You mentioned the foreign debt in 1951, but that was U.S. debt. Is there any factor that you consider the fact that today it's one-third foreign debt, or is that not a consideration or a fear from a geopolitical consequence that the deficit means more today than it did then?
so I'm impressed. You know the 1/3 number. Most people don't know the 1/3 number. This is a smart audience, or at least a smart audience member. Now, why I did that is because no matter what I now say, he feels good.
And it's the right answer.
That's
then.
it. That's
it.
It
Makes it the right answer.
So that's an old teacher. That's an old teacher trick. No. So he's right. Foreign debt. I mentioned 25 trillion.
Holders of foreign debt, meaning
Holders.
foreign holders of our debt.
Foreign holders of our debt is, you're right, it's about 8.5 trillion out of the 25, 26 trillion. By the way, the rest of the debt is held by us. So 2/3 of our debt is held by us. I'm ignoring the federal government owning it. 2/3 of it is held by us. So remember, we take it from us, and then we give it back, 2/3 of it to us. Okay? And by the way, how can we keep floating this debt? It's real simple. We keep getting more wealth so we can keep buying more debt. And given the choice of cutting spending, I'm not saying I agree with this, but given the choice of cutting spending, raising taxes, or printing money, or I'll buy some more bonds. We keep deciding, I'll buy some more bonds. I mean, I have more wealth, so I can without big pressure on the price because my wealth's growing, right? Fair enough. Now, the foreign part of that, we should never pay off the roughly $8 trillion in foreign debt. Why? Why would you ever give up the right to stiff them? Right? Seriously. I should never give up that optionality as a country. And we have not stiffed people, but lots of countries have over time or threatened to stiff them. And I'm not saying this is going to happen, but imagine we went in a real hot war with China right now. You think we would be paying interest to them? Not a chance. It is. It's like the old princesses. Prince and princesses in the old where you marry them off and so forth.
We think in some, right, they have leverage of us because they could dump our bonds. But on the other hand, we have leverage on them because we don't have to pay.
That's why you took my daughter and I took your son in the old royal marriages, right? Is that, and was it perfect? No, but it was. So,
but it helped keep the peace.
So interestingly, just one last thing on the foreign debt. You realize it's gone down as a percent of our GDP over I think it peaked in 2014 or something like that. So it's not gone down big as a percent of GDP, but it's gone down as a percent of GDP. So the foreigners, we basically we're using our additional wealth to buy our debt as a safe instrument. And the reason the foreign held debt has not risen as fast as us is their wealth has not grown as fast. So for example, I was just looking at this. GDP per capita in real terms in the United Kingdom is the same today as it was in 2007. So how can they afford to buy a lot more of our debt? They haven't created any more wealth. Germany's, these are not tricks either. These are just, Germany real GDP today is the same, GDP per capita is the same as it was 11 years ago. Ours is up 20% over that time period. By the way, does 20% pass a smell test? Yep. 1.7% annual growth in real terms for 10 years compounded is? 20%. So it passes the smell test, right? Why can we afford to keep buying more of our debt and these foreigners can't, right? So who's going to be the buyers of our foreign debt in the next few years? Guyana. Why? They just hit all this oil. If you just had all this oil and you wanted your money out of Guyana, where would you put it? In the U.S., where in the U.S. would you put it as your first venture? Federal debt. So it's more likely to be the net buyers at the margin are them. I'm just picking Guyana as an example, right? Than the UK. The UK is not going to be a big marginal buyer. They aren't creating any wealth.
All right, so let's end with predictions so that we'll have to have you back next year. Rate cuts either in percentage, like basis points, in not number of, but basis points.
Yeah, I only do basis points because number, if they did 50, is that 2 or 1, right? That's all I'm playing. I think you're going to see 4 this year. I think you're going to see 100 basis points.
Of total cuts.
Of total cuts. The consensus is around 25. I think 50 is a no-brainer.
Yeah, I think traders are pricing in 60% chance of 25 cuts.
Right. So it's in between 25 and 50. I think 50 you can't miss. And I think because the reason I said 75 to 100 are in the offing, but back-loaded in the year.
Where will the stock market end? I don't know if you like the Dow or the S&P, but whichever one is your benchmark.
Well, they both, the only difference is Dow doesn't weight by market share, and so it doesn't quite accelerate
Right, the way
as
the
fast.
S&P does, right.
I think it'll be something below normal. Historic normal is around 8%. If I had to come in, I'd come in at some number like 2 to 3%. I don't have any basis to say negative, but I think it'll be below normal. But not enough below normal that it's worth selling out your positions because you get killed on the capital gains, so that you'll go in net a loser. I mean, the market has to really fall by a lot to make it worthwhile to get out, at least for tax-paying entities if you've been in a while.
We'll end on two. Well, the easy one, oil.
So starting in 2014, the world oil situation changed dramatically, and that's when the U.S. began fracking in large quantities oil and totally changed the world of oil. And that's only been added to by Guyana and a few of these other countries coming in with large finds. And I keep mentioning Guyana because they have a big find and they're very poor, and the only way they get rich is pump. They don't get rich by talking about it, they get rich by doing it. And you say, well, maybe they take it out sooner than they should by some mathematical model. They want to be rich now. Okay? So that's biasing. And so fracking keeps it around 60 to 65 on fundamentals. By the way, you saw the world has changed. I'm old enough to remember what happened in the Middle East and the late 70s, mid-70s to late 70s, and what happened to oil prices, right? We bombed Iran. What happened to the oil price? It moved a couple of bucks for a couple of days. That tells you it's a different world. We're the largest exporter of oil in the world's history. We're the largest producer of oil in the world's history. Okay, and that changes a lot.
That's a big difference.
So, 60, 65, something like that.
So we're going to end on the last one, which I hope you'll answer, but maybe you won't. Midterm elections. Who wins the House and who wins the Senate?
Okay, so I'll be the first to admit, by the way, all Democrats think I'm a Republican if they read my stuff and listen. And all Republicans think I'm a Democrat. And they're both wrong because I think a pox on both their houses my entire life, because I don't have a rooting interest in it. If I want to root for something, I'll root for the Eagles,
This is over. We're done here.
I know. That's frustrating enough. I don't need to pile on by rooting for politicians. Look, I'm not an expert. All I read, all I hear, midterms generally favor the out of power party. I don't see any reason why that would change this time. And by the way, if you look at that historically, it's not even an indicator of whether, quote, good policies or bad policies have been implemented. It's kind of always true. So if I had to guess, the Senate will be close. I think they'll probably hold it barely on the Republican side by the vice president, if I had to put money, which I don't. And I think the House flips. And probably, I don't know, like a 15-seat majority for the Democrats there. And the thing I love, here's my view of politics, and I really love this stuff in the following sense. I'm absolutely opposed to the filibuster. It's anti-democratic. We should never have it. And the other party says, that's out of power, says, no, it's the cornerstone of democracy. Now the vote flips. And literally the same speech is it's like they handed it across the aisle.
Your turn.
And said, I've already written it. It's a really good speech. Now your turn to read my speech. I'll read yours. But don't crumple the pages because I'm going to need it in a couple of years. And that's my view of kind of how that shakes out.
All right. And then the last question. You will come back next year.
Look, when I landed here coming out of Philadelphia, you were up in New York, it was like a heat wave when I got off. You know, I stepped out to get a taxi, and it's like, oh my God, it's all the way up to 24. So yeah, if you can guarantee
All right.
it's balmy weather.
Well, make sure it's warmer than Philly.
That's all you have to do. Thank you very much.
Thank you.
everybody.
Thank you.
Okay, great job. Great job.